Three friends, Maya, Kai, and Ben, each dropped $10,000 into the market on the exact same afternoon. Same broker, same shaky finger hovering over the same buy button. One is chasing tomorrow, one is buying the entire board, and one is simply pocketing whatever shows up today. Here's the unsettling part, none of that decides who comes out ahead. What decides it is which of them panics, because 2 out of these 3 are heading toward a mistake they won't even notice for years. Point 3. The costliest investing mistakes never sting on day 1, they sting in year 11, quietly, right after you've spent months bragging about your returns. I'm Yank, and I've spent an embarrassing chunk of my life finishing the math that finance channels start and then drop halfway through the thumbnail. If you've ever had 3 people each insist a different fund is the only one worth owning, and you had no idea who was actually right, stick around, because today we settle it with real math instead of vibes. Let's keep this fair. Maya, Kai, and Ben are the same age. They earn identical salaries. They opened the same type of account on the same afternoon. Nobody inherited a dime. Nobody has a wealthy relative bailing them out. Nobody's getting a surprise windfall. The only difference between them is which 3 letters each one typed into a search bar. And keep this in your back pocket as we go, there was a 4th option sitting on that very same screen, the one this entire video is really about, and not one of the 3 of them touched it. So let's introduce the funds, because the whole story hides in fine print that nobody bothers reading. Maya picked Vanguard's flagship SP 500 fund, roughly 500 of the biggest companies in America, bundled into a single basket. It charges 0.03% per year, which on $10,000 comes out to $3. Not $3 a month, $3 a year. It's so cheap and so widely held that this past June it became the first fund in history to cross $1 trillion in size. Maya now owns a tiny slice of essentially the whole American economy, and it cost her less than a sandwich. Think of Maya as the market. Kai picked a fund tracking the NASDAQ 100, about 100 companies, leaning hard into technology, Nvidia, Apple, Microsoft, Broadcom, Amazon. Kai doesn't really hold a diversified basket, Kai holds a very confident opinion about artificial intelligence dressed up as a ticker symbol. It costs 0.18%, 6 times what Maya pays. Over the past 10 years, that fund turned $10,000 into nearly $72,000. Kai knows that number. Kai will bring that number up. Think of Kai as the bet. Ben picked a dividend-focused fund, about 100 thoroughly unglamorous companies that have paid shareholders for at least 10 years running. Banks, factories, the company that makes your toothpaste. It pays him roughly 3.3% a year in real cash, about triple the payout of the SP 500. So on day 1, Ben's big exciting reward is about $330 a year in dividends, showing up like a birthday card from an aunt, small, dependable, and a little underwhelming. Think of Ben as the checks. For the first year, none of this feels like a real contest. And it definitely doesn't feel like Ben is winning anything. Kai checks the NASDAQ the way some people check their horoscope, and for a while the universe is generous. Kai's 10 grand climbs, dips, then climbs higher still. At every dinner with friends, Kai has a story, Kai has a chart, Kai radiates that very specific energy of someone who's mistaken a bull market for a personality trait. Maya has almost nothing to report. Her fund did roughly what the entire market did, which is precisely the point of owning it, but it makes for miserable dinner conversation. She's left with a confirmation email and a faint sense of superiority. Ben has the least thrilling position at the table by a wide margin. His $300 in dividends lands, he reinvests it, and literally nobody is impressed. Nobody in human history has ever bragged about their dividend yield at a party and been asked to keep talking. So after year 1, the emotional scoreboard is obvious, the bet is winning, the market is fine, the checks are asleep. But the emotional scoreboard and the actual scoreboard are 2 very different documents, and over the following decade they start to disagree sharply. Let's jump to year 3 and put real numbers on the table, and I have to be upfront about my assumptions here, because this is exactly where most videos start quietly lying to you. Nobody knows the future return of anything, so instead of pretending otherwise, I'll use tempered long-run rates and label them clearly as illustrative, not guarantees. Say Maya's market fund averages roughly 10% a year, close to its long-run history. Say Kai's tech bet runs hotter, around 12%, because historically it has, while being a far bumpier ride. And say Ben's dividend fund does about 9% total once you count reinvested checks. At those rates, 3 years in, the market sits around $13,300, the bet is around $14,000, and the checks are around $12,900. Kai is ahead, visibly, smugly ahead. If the video stopped right here, the thumbnail practically writes itself, "Tech wins, by the Nasdaq, subscribe for more." But 3 years is nothing. 3 years is the part of the movie before the actual plot kicks in. The thing that decides the real winner hasn't even shown up yet, and when it does, it won't announce itself, it'll just walk in and rearrange the whole room. Here's the number that wrecks people. Over the past decade, Kai's bet didn't just return 12%, it returned closer to 22% a year. Watch what happens when you take that number and get a little reckless with a calculator. $10,000 growing at 22% a year for 30 years doesn't turn into a comfortable retirement, it turns into something absurd, $3.7 million from 10 grand. You can understand why someone runs that math once and then dumps their entire savings into a single tech fund. That number is a drug, and it's a lie, not because the arithmetic is wrong, but because no fund on earth compounds at 22% for 30 straight years. That rate is a recent hot streak, not a law of physics. Rewind to just one rough chapter, the dot-com crash, and that same style of fund fell more than 80%, then took over 15 years just to crawl back to even. 15 years, not to get rich, just to return to where you started. So the seductive version of Kai's story, the $3.7 million version, is napkin math. It looks incredible right up until you remember that no napkin has ever survived contact with an actual decade. The real math is much quieter, and it's coming for all three of them at once. By year 10, using those tempered rates, the three have pulled apart, but not dramatically. The market sits around $26,000. The bet is around $31,000, still out front. The checks sit around $24,000. If you lost track of the numbers, here's all you need going forward: Kai is winning, and everyone assumes it stays that way. Then the market does what markets always eventually do, it drops. This is the part no projection chart will ever capture, because it isn't a number, it's a feeling. Picture Kai's position sitting at $30,000. An entirely ordinary tech pullback, the kind that has happened repeatedly throughout history, knocks that fund down about 35%. Kai's $30,000 becomes $19,500 in a matter of weeks. $10,500 gone on a screen in roughly the time it takes to develop a nervous habit of refreshing an app. And here's the quiet detail nobody clocks in that moment: while Kai's screen is bleeding red, Ben's dividend still lands, right on schedule, the same unglamorous three-figure deposit as always. The whole market is on fire, and the checks guy just got paid anyway. He barely looks up. Now here's the test that actually decides this entire video, and it has almost nothing to do with which fund anyone picked. Does Kai hold? On paper, if Kai simply sits there and does nothing, the fund recovers and the story continues. But Kai spent 3 years telling everyone about that $72,000 figure. Kai's whole sense of self was up 11% this quarter. Watching that identity drop by a third overnight isn't a spreadsheet event, it's a 3 in the morning event. And most people, when they hit that 3 in the morning moment, do the one thing that turns a temporary loss into a permanent one: they sell. And that's the quiet twist buried inside this entire genre of video. You've been sitting here comparing 3 funds as if the fund itself decides how much money you end up with. It mostly doesn't. You do. There's a study run every year called Mind the Gap, and it measures something genuinely brutal: what funds actually returned versus what the investors inside those funds actually earned. Over the 10 years ending in 2024, the average investor trailed their own funds by about 1.2% a year, giving up roughly 15% of their potential gains, not because they picked bad funds, but because they got scared near the bottom and greedy near the top, and traded on those feelings. The wilder the fund, the wider that gap. The calm, boring funds cost people about 0.8%. The exciting, volatile ones, the bet-shaped funds, cost nearly double that. Let's put a real dollar figure on it. That 1.2 to 2% gap, dragged across 30 years on a $10,000 investment, quietly costs you around $49,000. $49,000, not lost to a crash, not lost to fees, but lost to the completely human act of flinching at exactly the wrong moment. Now, some researchers argue that gap is smaller than it looks once you account for how people add money over time, and that's a fair point. But even the softer version points in the same direction. The account leaks most through the hole labeled U. So far I've mostly picked on Kai, and if I stopped here, I'd be doing exactly what every tech fund influencer does, just flipped around. So let me turn the knife the other way and be fair to all three, because each fund carries a real weakness that its fan club conveniently skips. Start with the market. Maya's safe pick, the SP 500, sounds like pure diversification, 500 companies, the entire economy, what could possibly go wrong? But look underneath and it's nowhere near as spread out as it appears. A huge chunk of Maya's money is riding on the exact same handful of giant tech companies that dominate Kai's fund. Maya believes she avoided the tech bet entirely, she actually just took a smaller version of it while feeling cautious. And that's the most dangerous kind of risk there is, the kind you're certain you don't have. Now the bet. We've hammered on the volatility, but the deeper issue is what that volatility does to an ordinary human nervous system. A fund that can drop 35% is only great for the rare person who can watch a third of their money vanish and feel absolutely nothing. Most people are not that person, and they find out exactly which kind of person they are at the worst possible moment. And the checks, the dividend approach everyone dozed off on. Its weakness is the exact opposite one. Across these 10 years, the check simply earned less than the other two because Ben skipped the growth rocket entirely. He traded upside for stability and income, and that's a genuine cost. Safety is never free, it just mails you the bill later, in a currency called the gains you didn't get. Underneath all three sits a truth the thumbnails absolutely hate. Over nearly 100 years, the American stock market has averaged about 10% a year. But once you subtract inflation, the real number, the one measured in actual buying power, is closer to 7%. Inflation is the silent partner in every one of these accounts. Nobody invited it, it never says thank you, and it quietly takes its cut from all three of them, every single year. And a large slice of even that 7%, close to 40% over the long run, came not from stock prices climbing but from dividends being reinvested, the exact boring thing Ben's been doing this whole time while nobody clapped for him. Fees matter here too, in the same quiet way. Maya's $3 fee and Kai's $18 fee sound almost identical. Stretch them across 30 years, though, and Kai hands over about $7,000 more than Maya, purely in costs. And if any of the three had wandered into a typical 1% fee fund instead of these cheap ones, that single lazy decision would have cost roughly $40,000 over the same stretch. The fee you barely notice is almost always the one doing the most damage. So let's finally pay off the promise from the start and run the full 30 years, assuming all three actually hold on, which, as we've now established, is a fairly heroic assumption. Here's roughly where they land. At 20 years, the market has grown to around $67,000. The bet, at that hotter 12%, is around $96,000. The checks are around $56,000, plus every dividend Ben has quietly collected along the way. Stretch it to a full 30 years and it starts to look almost absurd. The market lands near $174,000. The bet climbs toward $300,000. The checks settle around $133,000. I know exactly what that table looks like. It looks like Kai just won the whole thing, and we all spent 20 minutes getting here for nothing. But look closely at what that big number silently assumes. It assumes Kai held through every single crash without flinching once. It assumes Kai never panic sold, never chased a hotter fund, never let one of those 35% drops quietly turn permanent. On a spreadsheet, the bet wins in a landslide. In an actual human life, it's the least likely of the three to survive contact with reality, because a spreadsheet doesn't have a nervous system. You do. So who actually wins? Honestly, it depends entirely on who you are, and I mean that as real advice, not a dodge to avoid picking a side. If you're just starting out, with decades ahead of you, and you want one single fund you never have to think about again, the market is extremely hard to beat, cheap, broad, proven, and boring in exactly the way that quietly makes people wealthy. If you have a genuinely long runway, an iron stomach, and can honestly promise yourself you won't touch the app during a crash, the bet has historically rewarded that kind of discipline extremely well. That tech tilt is exactly what powered those enormous numbers for the small handful of people who could actually leave it alone and let it run. And if you're closer to needing the money, or you simply sleep better watching real cash land in your account, the checks do something the other two structurally can't. They pay you while you wait, and that income cushions the fall when everything else drops. Remember Ben's underwhelming $330. Under these same assumptions, that payout grows to roughly $2,000 a year by year 20, arriving whether the market is up, down, or completely on fire. But here's the twist this whole video has been building toward, the fourth choice I told you to keep in the back of your mind. There was never a rule saying you had to pick just one. The fourth option was splitting that $10,000 across all three, a slice of the market, a slice of the bet, a slice of the checks, and then doing the single hardest thing in all of investing, nothing. When you actually track that blended trio over the last decade, it produced a genuinely healthy return. But the important part isn't the return, it's that the mix fell far less hard than the bet did on its own. When the crash hit, the checks kept paying, the market held the middle, and the whole thing dropped noticeably less, which meant you'd have been far less tempted to panic sell at the bottom. That's the version that actually wins. Not because it hunted down the single best fund, but because it built something an ordinary, nervous human being could survive owning through the worst week of their financial life. And that, right there, is the entire game. The real trap was never Maya's fund versus Kai's fund versus Ben's fund. The real trap is picking any single one of them because of a confident stranger on the internet, a 5-second clip, or something your cousin swore by at Thanksgiving, and then bailing the moment it actually starts to hurt. If building that blended plan yourself is the part you keep putting off, the exact 3 funds split in sensible proportions, plus the one written rule that stops you from selling at the bottom when your hands start shaking, that's exactly what we build together, step by step, inside our community, alongside a room full of people doing the same thing at the same time, so you're not white-knuckling the worst day completely alone. And if you're wondering what happens when you stop investing $10,000 just once and instead start adding money every single month, or you run all of this inside an account the tax man isn't legally allowed to touch, that changes these numbers more than you'd guess. We cover that inside the community too, but that's a different video. For right now, the next time someone insists to you they've found the single best index fund, don't argue with them about the fund. Ask them 2 questions instead. First, what does this actually return after fees, after inflation, and after you, an actual nervous human being, get your hands on it? And second, the question that matters more than any chart ever will, when this thing drops 35%, and at some point it absolutely will, are you going to hold, or are you going to become the reason your own investment failed? Because Maya, Kai, and Ben all put in the same $10,000 on the same ordinary afternoon. In 30 years, the gap between them will have almost nothing to do with the 3 letters they typed and almost everything to do with what each of them did on their worst day. Pick the fund you want. Then make absolutely sure you've picked a plan you can actually survive. The real trap is picking any single one of them because of a confident stranger on the internet, a 5-second clip, or something your cousin swore by at Thanksgiving, and then bailing the moment it actually starts to hurt. If building that blended plan yourself is the part you keep putting off, the exact 3 funds split in sensible proportions, plus the one written rule that stops you from selling at the bottom when your hands start shaking, that's exactly what we build together, step by step, inside our community, alongside a room full of people doing the same thing at the same time. So you're not white-knuckling the worst day completely alone. And if you're wondering what happens when you stop investing $10,000 just once and instead start adding money every single month, or you run all of this inside an account the tax man isn't legally allowed to touch, that changes these numbers more than you'd guess. We cover that inside the community too, but that's a different video.